You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Derivatives are sometimes associated with the risk-taking that exacerbated the global financial crisis, but they can also support systemic stability by protecting banks from the uncertainty and rapid changes that characterize today's rate environment. With aggressive Fed tightening the last 2 years, banks have used these tools to increase earnings and minimize the risk that can accompany interest rate volatility. On today's episode, we talk with Brian Matochik and Christian Turner, Senior Vice Presidents with the Derivative Products Group at FHN Financial, about how the use of derivatives has evolved the last few years and how these tools can add value for banks in a falling rate environment. Stay tuned. Coming up soon, our interview with Brian Matochik and Christian Turner, Senior Vice Presidents with the Derivative Products Group at FHN Financial. But first, a quick market update. The Fed left rates unchanged this week, as expected. While the median projection within the FOMC was still for 3 rate cuts this year, there was broadly upward movement in the dots for this year, 2025 and 2026. This suggests a less dovish policy path over the next few years than communicated at the Fed's December meeting. Nonetheless, the economic projections this week, along with Powell's press conference, signal the Fed's robust confidence in the inflation trajectory and the ability to achieve a soft landing. Powell also said the Fed should be ready to begin tapering its balance sheet runoff fairly soon, even though he gave no concrete timeline or plan just yet. This week's meeting came in the shadows of some worrisome February inflation reports that were released in the Fed's pre-meeting silent period, leaving FOMC participants unable to speak publicly about how the new data releases shaped their thinking. January inflation data appeared anomalous at first, driven by weather disruptions and seasonal adjustment issues, but a 0.4% monthly increase in the core CPI and a much faster than expected increase in the core PPI have renewed doubts for market participants that the road to 2% is inevitable. Treasury yields across the curve rose around 25 basis points after the inflation reports last week, establishing 2024 highs for most tenors before the Wednesday Fed decision. The initial market reaction to the Fed decision was choppy, and we expect a more complete repricing won't come until the end of this week. Fed funds futures trading still shows an expectation for 3 rate cuts this year, most likely beginning in June. The Bank of Japan hiked the upper bound of its key policy rate from negative 0.1% to positive 0.1% this week, ending this negative rate regime that had been in place since 2016. The BOJ also introduced more flexibility in the path of rates on 10-year JGBs, which had previously been anchored at 0% under the bank's yield curve control policy. This week's developments are a notable contrast to other major central banks around the world that are on the precipice of policy easing. That's all for the market update this time. Now, our interview with Brian Matochik and Christian Turner. We have 2 guests joining us for today's episode, Brian Matochik and Christian Turner, both Senior Vice Presidents with the Derivatives Products Group at FHN Financial. Brian and Christian, thanks for coming on the podcast.
Thanks for having us. Hey, Will, good to talk to you.
Our topic today is derivatives, what they are and where they can fit into strategy for financial institutions. Some of our listeners probably have an idea of what derivatives are, but that term can mean such a wide variety of things. So, Brian and Christian, I think it would be helpful to start out with just a basic definition of what a derivative is, and from there, the specific derivatives products that your group specializes in.
Derivatives encompasses a lot of things. It's a huge market. It's one of the most highly traded markets in the world. And there's a lot of things you can do with derivatives. But in a nutshell, basically what our group focuses on is hedging, and in particular, hedging strategies for financial institutions where you will use a derivative to help an institution, as a tool to help an institution manage interest rate risk or improve earnings. I remember, Mike Delisle a few months ago, he said it very well when he said banks in particular are always making risk or reward decisions, right? So, institutions are making decisions on how they can mitigate interest rate risk or how they can improve earnings. Well, I kind of like to think of derivatives as an enhancement to that. So it's a tool that bankers have in the toolbox to better mitigate interest rate risk or to improve earnings even more. So it's really just kind of this tool that institutions can use to more efficiently improve earnings or manage interest rate risk. Well, I'm old enough to remember flip phones. It was the first cell phone I ever had was a flip phone. And you could send text or call with a flip phone, right? And now we've got these iPhones and there's apps for everything. You can help you organize, you can surf the internet, you can do email. In a sense, derivatives are kind of like having that iPhone. It's just some more tools that you have in the toolbox to get things done a little bit more efficiently. And I think that's the way I like to look at it.
I think that's a great analogy, actually, that helps me a lot. And I think it is then important to go to my next question, which is that to some people, the term derivative in the context of the financial industry, they quickly think of the global financial crisis. So with that, maybe some connotation of lots of risk-taking and behaviors that cause systemic instability. What is your sense of whether derivatives are safe financial instruments right now in 2024? Have we moved too far away from that flip phone? Are the apps that we're using in derivatives too complex and we've just got to get back to the bread and butter texting and phone calls?
Well, I think that's a really good question. For the most part, we do stay a little bit more basic. Now, we do execute all types of swaps. We do look at options as well. But for the most part, what we're trying to do when we're hedging, we're not working on proprietary trading. And what a lot of firms may have done is maybe stepped out a little bit over their boots. What we're going to do is we're going to make sure that our hedges match up very closely to the needs of that portfolio, meaning we're not going to take on additional risk. We're there to mitigate the risk. So if we are trying to put on a hedge that's a little too complicated or possibly going over and above their needs, they might actually be adding on risk. So in those situations, yeah, I think that would be a little dangerous. However, if you're looking at the financial crisis or back in the 80s when you're talking about savings and loans, a lot of hedging deals with loan portfolios or mortgage portfolios. And what happens is in certain situations, if they put on these hedges when rates are too low and rates spike drastically and people panic and they unwind the hedges, they are apt to take losses on those hedges. But that's not what we're trying to do here. What we're trying to do here is match up the loan and the hedge or the balance sheet and the hedge so that they follow in sync through those different interest rate cycles. It's not there to be taking gains necessarily or to take losses necessarily, but more so to protect you during cycles so you flow together whether rates go up or down. That's the intended target as far as our hedges go. So I think no matter what happens as far as how complicated they get, our process stays pretty vanilla in the fact that we're going to make sure that we are matched up very closely to whatever we're trying to hedge. And we're not going to take too much added risk because, again, we're there to mitigate that interest rate risk, not add on. And by maybe doing something a little too complicated, you might be adding on risk.
I think that point of complexity is really interesting. So the language and mechanics of derivatives might be new for a lot of institutions that could otherwise be able to get value from derivatives products. So are derivatives something that need to be actively supervised and traded? Do they happen mostly in the background? How should people think about the uses of derivatives if they are new to the scene? Would this type of accounting be difficult, for example, for a community bank?
This is a good segue, I think, Will, because derivatives are a powerful tool and they can be misused. But in terms of the accounting and for financial institutions, well, but actually, before I get into the accounting, it is prudent to be kind of wise financial managers, especially when you're using derivatives and kind of know what you're doing. They are simple tools in a lot of ways that you can use to enhance things that you're doing on your balance sheet as a bank, but they can be dangerous. Kind of using that old cell phone analogy, iPhones can be dangerous. There's a lot there and it's a big world, and they can be dangerous tools if you don't use them in the proper way. And that kind of gets us to the notion of hedge accounting. Hedge accounting is a way that institutions can elect this favorable accounting treatment for derivatives, but really hedge accounting kind of fences in the playground, so to speak. Kind of the notion of hedge accounting, it's a way to kind of tie a derivative to an asset or liability on your balance sheet. So in a sense, it kind of limits, what you're able to do and kind of confines and restrains you a little bit there. But that's a good thing. And hedge accounting rewards you for that. So it kind of puts limits on the type of hedging you can do so that you don't exceed risk that you have on your balance sheet to a considerable extent. And you kind of operate in this framework of your current asset liability mix. We tie hedge accounting, again, you would tie a derivative to something that's on your balance sheet. And then again, hedge accounting rewards you for that. It allows you to get this favorable accounting treatment so that you're able to mitigate some of the market value movements of a derivative that you're putting on your balance sheet. I can remember back, I guess it wasn't that long ago, there was a book called When Genius Failed, and it's a pretty popular book, but it was kind of about this hedge fund that, really what they were doing they were used a lot of derivatives, but they just kind of put their foot down on the gas and just were trying to maximize earnings and maximize revenue and were speculating. They were using derivatives to speculate, and it cost them a lot. I mean, when those derivatives went the wrong way, they took a huge hit. And not to spoil that book, but there were a lot of far-reaching implications for doing those types of derivatives without hedge accounting treatment. So a lot of the stuff that we do is we help institutions get that favorable accounting treatment whenever they want to look at a hedge. And I think that's important, that you kind of know what your parameters are and know how to get that favorable accounting treatment, which is something that kind of one of the primary things that we help institutions do.
How do regulators view derivatives? And I hate to keep typecasting them in this context of excessive risk taking, but do regulators today see derivatives as a reluctant part of the financial industry? Are they helpful in making the industry run smoother? What do you think runs through the mind of a regulator when they see a bank is trading in some of the derivatives you're talking about?
In my opinion, and just knowing what we've dealt with as auditors and other regulators we've come across, I think it's a very obvious line between the firms and the institutions that are using derivatives to help reduce their risk and to keep their banks safer, their institutions safer. And like Brian said, by using tools such as the hedge accounting treatment, you're really limiting the amount of derivatives you use to maintain that kind of risk mitigation. So if you go too far past that, now the regulators might look at it a little bit differently because you are at that point adding on risk. But I think there is a very obvious line between the two. And so when we're looking at the balance sheets of our customers or we're looking at individual loans, we're making sure that we fall well within those guidelines. So not only are we staying within, like Brian said, the playground parameters, but we're also staying very well inside of that. So we make sure that we are following those guidelines very closely and there's no deviation. Now, if you were to put on derivatives outside of those guidelines, you're absolutely adding on risk, which might be planned risk. That's not something that we necessarily focus on in this area. Still, we're here to help the banks protect versus add on additional risk. So I think when the regulators see the reason that you're doing it and they see that effective hedge accounting treatment was viable and that we have the documentation behind it, it actually looks like a very good risk protection measurement. So I think it works well in the institution's benefit.
The environment in the decade before the pandemic was so different than the first couple of years of the pandemic and then the most recent 2 years during Fed tightening, because a lot of the descriptions you two have discussed have to do with interest rate hedging. And for the decade before the pandemic, interest rates weren't moving very much. It was a slow and gradual process. How has derivatives trading changed during those periods of time when the environment for banks has shifted so much?
The environment has been very interesting that we've been in, to your point, over the last several years. And what it's really done in the hedging space is just kind of opened up opportunities, I think. You've got a lot of opportunities here depending on, what your view of rates might be. Hedging tools can be used, again, to mitigate risk, but they can also be used to improve earnings as well. Some of the strategies that we've kind of seen develop over the last several years, number one, we have seen a significant increase in hedging activity in the community bank space in particular. So which has kind of gone hand in hand with the viewpoint that auditors and regulators, how they view derivatives, when more and more banks are using them and they're safely using them to manage interest rate risk, a lot of regulators and auditors are number one, used to seeing them on bank balance sheets, but number two, seeing the value of hedging. And that's one of the things with these dramatic increases in interest rates that we've seen and the dramatic changes we've seen in the interest rate environment in general. We've seen this uptick in hedging activity, and there's been a lot of opportunities. So, right now where we sit today is we've got some institutions that are starting to get a little bit concerned about rates potentially falling in the future. And now they're looking at strategies to mitigate falling rates, such as receive fixed interest rate swaps and interest rate floors. Coming out of the pandemic, a lot of institutions were looking at hedging rising rates with pay fixed swaps and interest rate caps. So there's a lot of different tools, a lot of different opportunities that we've seen kind of open up in this challenging interest rate environment we've been in.
To add on to that, abnormal environments require abnormal solutions. And at the beginning of the pandemic, when rates were virtually at zero, we knew that there was a great opportunity. However, we didn't expect the amount of community banks that would come in hoping to take advantage of that. We had quite a few new customers that are now regular derivatives customers because they saw that by taking advantage of such, large moves in the market, you can do it safely, you can do it easily. They don't need to know every detail about derivatives. That's our job, is to kind of hold their hand and help lead them through it. But by taking advantage of that extremely low interest rate environment, they were able to increase income drastically to protect assets. And at that same time, now that they're seeing a turn in rates, they have a little bit more feel for what's happening and how to use those derivatives. So they're getting a little bit more creative and, putting the whole foot in the water, not just the toe. So we've had quite a few new ones come in with that low interest rate environment. And now with this higher interest rate environment, they're a lot more apt to try new things. So it's been nice to see new customers come in.
I think that naturally leads to my next question, which is this environment that appears to be just on the horizon later this year. We're most likely on the verge of lower interest rates sometime in 2024. What value can derivatives provide to banks when the Fed appears to be on a trajectory to ease monetary policy? So it looks like lower interest rates are in the future. They're not here yet. How should banks think of the value that derivatives provide in that climate?
One of the primary strategy that banks are starting to consider as we approach the potential easing environment where rates could fall here in the near term is to protect floating rate loans. Okay, so a lot of institutions have prime-based loans or floating rate loans that have done well in the rising rate environment we've been in over the last couple of years. But now, as if rates do start to fall, those loans are going to start repricing lower. And so one of the hedging tools that a lot of banks are starting to consider is converting some of those floating rate loans to fixed using an interest rate swap. And so by doing that, the institution is basically going to take that floating prime rate that they're receiving on the loan, and they're going to convert it to a fixed rate. So they're going to be receiving a fixed rate on that swap and paying a prime rate. So as rates fall, if prime falls below the fixed rate that they're receiving, they're going to have protection there. So it's going to protect that institution from a falling rate environment in the future. And institutions are always also looking at purchasing floors that kind of do the same thing. A floor is like buying insurance. So a swap is this contract that you enter into with no cash outlay. You just convert your prime-based loans to fixed. And a floor is a way you can kind of buy insurance for an upfront premium. You can have this floor protection that if prime were to go below that floor, you bought this protection, you bought this insurance, and it's going to give you income if prime falls below that floor rate. So those are a couple different strategies that the institution is starting to consider as we approach that next easing cycle.
I want to close out with a question about Silicon Valley Bank or regional bank tensions we saw last March. So we're coming up on just about a year since SVB failed, and people started to get worried about whether there were systemic vulnerabilities in the regional banking sector. When you look back at what caused regional bank tensions last March, is there anything that derivatives could have done to minimize the pain that banks experienced from adjusting to rapid Fed hikes? And of course, this is, in hindsight, 11, 12 months later, but would derivatives have helped smooth that process as banks adjusted to such aggressive Fed policy so quickly?
What's interesting about Silicon Valley Bank, Will, is they actually had hedges in place on their securities portfolios that they had terminated prior to the kind of aggressive rate cycle. So they had hedges in place, but these hedges had positive value. And so they had terminated these hedges and taken some gains. And then at the time that, we saw the dramatic increase in rates, they didn't really have a meaningful hedge in place on their portfolio at that time. So to answer that question, yes, if they had kept or had put on or replaced those hedges with some meaningful hedging on their securities portfolio, then that would have considerably allayed investor concerns regarding the market value risk that they had in their portfolio. So hedging could have protected them to a significant extent from a rising rate environment had they either left those hedges in place or put new hedges on, prior to the dramatic increase in rates.
Brian and Christian, thank you for coming on the podcast.
Thank you, Will.
Thank you, Will.
That was Brian Matochik and Christian Turner, Senior Vice Presidents with the Derivative Products Group at FHN Financial. With derivatives often viewed in the context of excessive risk-taking just over 15 years ago, I think it's interesting to hear Brian and Christian talk about how helpful derivatives can be in protecting against risk rather than creating additional risk in the financial sector. As rates appear likely to decline over the next few years, it's also helpful to know that banks can use interest rate swaps to help protect their floating rate loans in a falling rate environment. Fed officials are now free to speak publicly about their views on the economic and rate trajectories. A handful of FOMC participants already have scheduled appearances the next 2 weeks, though Chair Powell is so far not among them. February's PCE report next week will give a more precise look at how inflation and personal spending fared last month, after early suggestions from the CPI and retail sales data were somewhat dour. The core PCE deflator is expected to have increased 0.3% to keep the year-on-year increase at 2.8%. Both March ISM reports will be released the week after, setting the market tone before the March employment report on April 5th. After the February report showed robust job growth with an uptick in the unemployment rate to 3.9%, investors will keep a close eye on whether payroll growth slows or the unemployment rate rises above the 4% threshold for the first time since early 2022. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.